I'm Jeff Townsend. I'm here from Critical Productions, and I'm joined by Olimpia Pilch from the Critical Minerals Association UK and Critical Minerals International Alliance. Olimpia, last year you wrote the Critical Mineral Association UK's financing paper called Funding the Future. Can you tell us a little bit more about why that paper was written?
Absolutely. So financing is the number one issue that industry and governments always talk to us about. So of course, you can talk about the energy transition, but you don't have that without the critical minerals. But you cannot get the critical minerals out of the ground without first financing it from exploration all the way down to production. Now, the biggest issues we are seeing is actually attracting finance into those early stages, from exploration to bankable feasibility studies now. On average, it takes about 12 years to get to that space, not because of technical challenges, not because of any kind of community opposition as such, but because of financing issues and how long it takes to attract private finance into this sector. Now, of course, if we look at geopolitics, if we look at traditional mining finance options, which is debt and equity, you start to see a little bit of a disconnect. Of course, the geopolitics and critical minerals are not separable, they're stuck together. So if you're trying to finance things like tungsten or rare earths, it becomes incredibly difficult to attract investors from the private sector to put their cash into these projects, which are very high risk, probably low return because they have high strategic value but not a high commercial value. And of course, they are at the whims of monopolized markets. So financing is a huge, huge problem for the industry, and of course it's one that we cannot ignore any longer. So this paper has been looking at alternative ways to finance critical mineral projects, and we spoke to a number of members and industry experts to figure out how can we move this forward, how can we make sure that we meet the energy transition goals.
The paper then went to the Treasury and was used ahead of the budget. It came up with some alternative mechanisms by which we may be able to finance the critical mineral space. What was the first one?
So the first one was flow-through shares, which have been employed in Canada very successfully.
So I really like flow-through shares. We don't have them in the UK. They're very limited to where they are operating around the world. But if I understand correctly, there's something like a three times return. So for every dollar in Canada spent through a flow-through share, we're seeing about a $3 return on that investment, which is great, which is definitely one way to finance and speed things up. We had the opportunity to speak to Peartree Resources, and they're experts in this space, and they're going to tell you more now. Nice to see you again, Lisa. Can you please tell me about flow-through shares and how they work?
Actually, the flow-through share regime in Canada has been around for about 50 years now, at least. And what the Canadian government has done is they've created a version of a common share, really simply a common share, but there are tax attributes associated with it so that the mineral exploration company that's issuing the share can transfer the resource expense from the company, which is not taxable since it's not revenue producing, to the investor, which has taxable income, and the investor can then use that expense as a deduction for tax purposes against the investor's own income. And in addition to that, both federally and it's different across different provinces, but other provinces do offer specific credits for mineral exploration done via flow-through shares. So as a result, the after-tax cost of an investment when you're purchasing common shares, which are issued as flow-through shares, is significantly reduced. The other thing I would mention, though, is that really the flow-through share market has developed and changed dramatically over the past dozen years or so. So when Peartree introduced a new business model, which is flow-through share donation financing, the typical investor being either directly a retail individual investor or more often a fund, a limited partnership that would pool a bunch of flow-through share investments, was over a period of years largely supplanted by Peartree's business model, which is one in which we separate the tax benefits for the original Canadian resident subscriber and then sell the underlying equity to another investor who can then just acquire common shares, but at much better pricing, because the initial investor will pay a considerable premium because of the tax benefits associated with those shares, whereas the what we call the end buyer can then usually acquire those shares at a substantial discount, and the issuer of the shares is still able to command quite a healthy premium and thereby reduce dilution.
Can you tell me then a couple of the benefits that flow-through shares would have for both the junior mining sector in Canada, but also for those investing into flow-through shares?
Well, some of those benefits really are, I would say, shared between both groups, because as an example, what I just mentioned a moment ago is that, the greater the premium you're able to issue your shares at, the less the dilution that the mining company is forced to take on. And it's good for the company, but it's good for all shareholders, because to the extent the company is going to end up doing well, it's doing better per share, so less dilution is good for everybody. And just in general, I mean, the capital markets for the non-revenue producing junior companies are very challenging, and because there are, a group of relatively, high income earners, or at least like income earners in Canada at the top marginal tax rate, there's a great incentive for them by purchasing flow-through shares to reduce their tax burden. So it's worked very well. And one thing I will say, particularly talking to you, Jeff, and sort of knowing your background and interest, is that in 2022, the federal government added a new credit on top of the existing flow-through share regime, specifically to incent exploration into critical minerals, a group of 15 of the critical minerals, I guess, deemed most important for accelerating the greening of our economy. And it's a 30% credit, and it's been remarkable to see how quickly that's resulted in those explorers looking for critical minerals being able to find the capital that they need. I mean, traditionally in Canada, gold is sort of the metal of choice, and we've seen in our own business moving from sort of 85-90% of the financing going to gold exploration to probably now maybe a 50-50 split between gold and critical minerals. And that happened virtually overnight. I mean, in the first 18 months that credit was introduced, I think about $500 million found its way into critical minerals exploration.
Amazing. Well, thank you ever so much for your insight, and we look forward to talking to you again in the future, perhaps catching up in a few months' time or post PDAC to talk about flow-through shares and what Peartree are up to again. Thank you.
Terrific. Thanks, Jeff.
So the next was industry matched loan and grants. Can you tell us more about that?
So at the moment, there's limited pool of finance available, especially for UK companies. So one of the ways that could help attract private investments and reduce some of the risk is to ensure that the government, for example, provides a 50% loan that then has to be matched by industry. Automatically having that government sign-off approval attracts investments from the private sector, and it helps projects to get off the ground much, much quicker. Of course, loans are not always the best available option, especially for early stage exploration projects. This is where the grants come in, especially for projects of strategic importance that will benefit the defence or the tech or even the most crucial economic sectors of the UK's economy.
Yeah, that's the interesting thing, isn't it, really? Because we're struggling, and the world is struggling to finance the junior mining sector, these early stage things, and you can understand why. If you're an investor, you'd either invest in copper or bulk mining where you know the returns, or something like fintech where there's just a definite higher return on what you're doing. So there's a lot of reasons as to why you wouldn't invest in the junior space, but I guess if governments are de-risking, then that really helps drive that forwards. And I think, if I'm not mistaken, we're starting to see that with the British Investment Bank.
So yes, we have been seeing that, especially with Cornish Lithium, which actually we spoke to Jeremy Raffle, the founder and CEO of the company, who kindly provided us with a case study on how they went about alternative financing through crowdfunding.
Jeremy, I was wondering if you could just tell me quickly about the crowdfunding route that you went through with Cornish Lithium, and firstly, how you would go about that as a junior mining company.
Our journey was that we started off, I started the company self-funding and then went on to angel funding and then went on to crowdfunding because we had over 600 people write to us asking if they could invest. And this was an extremely effective way of raising additional funds for our company, and it worked extremely well for us.
And when you were doing it, what were some of the key points you needed to know before going into that crowdfunding space? What are the key issues you needed to know, or challenges that you needed to overcome?
Yeah, I think it's really important before embarking on any crowdfunding process that you know that your offer to potential shareholders resonates with them. So you've got on various crowdfunding platforms a large number of people who are looking to invest, but the offering has to be relevant. Is it the energy transition? Is it UK industry? Is it something that will grab people's attention, that they really want to? It's not just about money and return. It's about something that they make a material difference to and feel part of. So that's one of the things. I think it's massively important to use the EIS, Enterprise Investment Scheme, if you possibly can, make sure it's before you have the permission, before you go on the crowdfunding. Otherwise, you're going to end up with very disappointed shareholders if they don't get that EIS, as it is a fantastic scheme, which if the tax is relevant to you, you can claim substantial tax back. So it's really positive. You also need to make sure that you have secured or have at least been confident that you're going to raise at least 50% of your base level raising. So if you're going to raise £1 million, you need to be fairly confident you've already raised 500,000. So that not committed, but you go into this not starting at completely zero. And also you need to be able to get your message across in a video less than 3 minutes long. You do need to be able to make a compelling case in a video within 3 minutes, and that's what really grabs people. But really, I think you're taking people along with the journey, so they're excited to be part of it. Is the main thing.
And I guess that's one of the benefits of going down the crowdfunding route is you bring people on that journey. Are there any other benefits you've seen at Cornish Lithium?
Yeah, I think that you actually get a large audience of people who are, supporting you. In our case, a large number of our crowdfunding people are based in Cornwall. So you've got a large support base in the area where you're operating, but also across the whole country. You are getting a lot of people who are watching you, supporting you. That's obviously a two-edged sword if you don't want to disappoint those people. And I think you also need to have a passage to raising more substantial funding through more conventional reasons means like private equity, as we've already done, so that crowdfunding can be seen to be progressed in towards construction and actually building the project.
Brilliant. Well, thank you very much, Jeremy, and we look forward to coming back to Cornish Lithium in a couple of months and seeing how things are going. Thank you.
Okay. Thanks, Jeff. Cheers.
One of the other things that we see is offtake agreements, and actually the rest of the world seems really good at this. The idea that that if you can secure offtake, then you have a guaranteed demand for your product, and therefore you're a much more bankable project to invest in. Can you tell us more about what the paper says around that?
So the offtake underwriting is extremely important, especially if we look at the strategic position of the UK. So prior to this paper, we released another one on the midstream and why the UK desperately needs to have some processing and refining capability. We're never going to be a major mining nation. We just simply do not have the resources, although we have some excellent projects. But we have the capability, especially around access to free ports, the chemicals industry, and access to clean energy. We can have hubs or clusters of processing and refining facilities within the UK. Now, of course, you can't have the midstream without having the offtake, or they all come from somewhere, which means that for UK companies to secure it from whether it's Africa, whether it might be Greenland or Australia, there needs to be some kind of guarantee, especially for brand new projects that haven't proved that they work yet or are still in the concept stage. Government's offtake underwriting can help reduce a lot of that risk that will hold investors back, especially because the midstream is such a geopolitically strategic space and there's a lot of markets manipulations and maneuvers that really terrify investors away from the space.
Yeah. So someone, if Jeff Refining, let's say, is set up in the UK, no one's going to sell me offtake because they don't know I've got the cash. But if I come with my friend from the UK government and saying we're going to underwrite and we're going to pay his offtake even if he can't do it himself, then that's actually going to secure offtake for my new refinery that's currently a PowerPoint presentation.
And it's more likely to attract the investment necessary to actually build that plant.
Yeah, and we're seeing some good midstream projects creeping and coming to fruition in the UK at the moment. So, that makes a lot of sense. And I think, if I'm not mistaken, that the current mandate of UKEF is that they can underwrite it offtake going out of the UK, but not into the UK. So obviously you need to do a little bit of changing of that one. The next thing that the paper looked at was tax incentives. Tell us more.
So we've already heard about the US and the Inflation Reduction Act, which caused quite a stir in response to some of China's own initiatives to make sure that more investment happens around not just critical minerals, but clean energy in general in the US. And of course, that has had a knock-on effect on attracting a lot of particularly Australian companies who are now looking to sell or send the feedstock over to the US. Now, tax incentives are absolutely crucial if you think about the strategic positioning of projects such as whether it's rare earths or it might be tungsten or something like those lines, which are not as commercially appealing as commodities such as whether it's aluminium or copper. So it's absolutely crucial to level the playing field across MSP nations, so the Mineral Security Partnership, to ensure that there is some collaboration, but so that Western companies can compete effectively in an already monopolized market, which is heavily backed by incentives from China. So when it comes to competing on costs, if we take Australia as an example, so you have high transport costs, you have high energy costs, plus various issues of planning and permitting. That, of course, delays how quickly you can get critical minerals out of the ground, and of course, it turns investors away. Whereas with tax incentives, you can bridge that strategic and commercial gap. Now, if you look at the UK specifically, because we have such a tiny critical minerals industry, if you then have some kind of tax incentives or tax write-offs, the UK does not lose that much from an industry that doesn't really exist if it ends up growing a sector that is really successful, ends up growing mines and ends up producing critical minerals, whether it goes all the way down to the refining stage. So of course, tax incentives can be quite powerful if they're used correctly.
So when we talk about tax incentive, my mind goes to the difference between commercial viability and strategic necessity. So you're not going to see investment from traditional things going into a project that's succeeding but needs to massively grow to meet strategic goals of governments or, the defence sector. So you get a gap between the commercial viability and the strategic necessity. And I guess if you can use tax incentives to reduce that, it's cheaper for the government, marvellous, but also B, it makes it a lot easier for those companies to grow and to fill that strategic goal.
Absolutely, and it also ensures that the Western world, whether it's the UK or the US or wherever else, is not left out of the race or with a supply chain that's extremely vulnerable, because commercial viability renders a lot of these strategic projects uninvestable to a lot of institutional and private investors.
And the final one the paper picked up on, after talking to a lot of the companies, just direct investment.
Absolutely. And I think this is what we hear from industry all the time. Please give us money, which doesn't quite work like that, especially in the UK. So industry would like, ideally, some injection of cash, whether it's, I don't think industry always asks for big sums, but to have that support. And I think it comes with that stamp of approval from the British government, that they are standing behind the industry, they're willing to support it. And this is the sector that matters. That in turn sends a signal to the market that actually the UK government's serious about this. They will protect the project if it comes to it. And of course, investors like to have security and to de-risk. So direct funding is always attractive to the industry. There are limited coffers and it's always taxpayers' money. It's not the government's money. We have to keep that in mind.
Yeah, and look, governments don't like picking winners, number one. Number two, they've had their hand bin a couple of times, and they don't really like that direct investment because ultimately people still believe in the free market. So it's a tough one. It's what industry wants, but it's very hard for governments to do that. So I think what we've learned is there is a gap in the critical mineral space, and traditional funding just isn't filling that gap fast enough or broadly enough. There are players in the space and they're doing great work, but there's not enough. And the reality is if we're going to meet net zero agendas and fight climate change and build this green economy of the future, we need every single project to succeed that can. And that comes down to financing.
Yeah, financing is the number one issue that needs to be addressed, but it's not simply an industry issue, it's not simply a government issue, it's a collective issue. There is no way that the private sector is going to bridge the gap between the commercial viability and the strategic viability. And of course, governments can't, most of them can't afford to pay for all the strategic projects that are absolutely necessary for national security and to have some foot within the critical mineral supply chains.
Thanks, Olimpia. I think the report is excellent. It got great feedback from the UK government. It's had good feedback from those who have read it now outside of the UK government. It's online at the Critical Minerals Association website, which you'll find in the link below. So thank you for the paper. Thank you for your thoughts. And I'm sure this year, when we really need critical minerals to succeed, finance is going to be the fundamental issue.
Absolutely, finance is going to be the number one issue. So we'll be keeping an eye out on the industry, how they progress and how new and evolving funding mechanisms come into play. So stay tuned and I'm sure we'll be keeping you up to date.